So I literally just recorded a 9-minute video and forgot to mention something that I really wanted to share. Um, so this is going to be quick, probably like 5 minutes. I'm just going to recap what I went over in the video. So this is Monday. This is the 9th of March. It's already the 9th of March. Isn't that crazy? Feels like just yesterday, like it was 2026. Now we're 3 months in. 2027, 2028. It's crazy. Anyways, so looking at Monday, right? Boom, right away you got a mark 0830 opening price, which is about 24,454. When prices up and down like this, you kind of just got to be like, you got to be cautious. You got to wait for data to print. Um, More often than not, when it first goes, like the first initial pump or whichever, like the first long run of the open is usually a Judah swing, which is kind of like a fake out. It's faking all the participants in the marketplace like out because it's saying like, oh, I'm going in one direction and I might keep going down, which would have made sense. There's a lot of sell side liquidity here, but then it rallies and rallies. This is all manipulation though. This is a week's worth of range and it did it in one day. Anyways, get back to the trade. So 0830, you could have shorted here for sure, made a profit aiming for these relative equal lows. It's not a bad trade. The only reason why I say that's probably not the best option is because the opening range gap was above price at the time. So this is the opening range gap annotated in the blue lines. So opening range gap plus you have new week opening gaps nested up here, and some relative equal highs. Like I mean, you could have gone short for the first initial couple minutes of the open, but other than that, that was kind of the only opportunity you had was to short this inversion for value gap and get some market run here. But the lines portion of the run was definitely going long, which wasn't really clear today. I mean, bias wasn't like super clear today. I mean, it just dropped like hundreds and hundreds of points over the weekend, which automatically sets unhealthy market conditions. Uh, Based off of what happened over the weekend, you should like already be cautious because of how the market. Oh, sorry, because of how the market is. I mean, just behaving. Look at like this is nonsense, right? I mean, it's not as bad as when Trump first got into office. Shit was like this was going down every single day, and I mean, it's similar conditions right now with like Iran getting bombarded with big bombs. Yeah, it's going to create erratic behavior in the marketplace, but you can still navigate it. So 0830, you could have taken this trade, but then this trade takes buy side liquidity. Okay, so now what do we do? What's the market going to do next? Takes sell side liquidity, which it does here. Okay, so now you have to really determine where price wants to gravitate to. Opening range gap is above price at this current time, this current pocket of time, and new week opening gaps. Okay. So this sell side imbalance, buy side inefficiency was created during the macro. So you want to annotate that if you're looking. Okay, boom. Now you get inverted right here at 1022 by this candle. That's an entry right there. You could put a stop loss in a couple places. You could put it at the low of the body that created the inversion for value gap. Let me make that red. You could put a stop loss there. It would not have been stopped out if you're precise. Um, or you can use the this candle, the one that violated the inversion for value gap. Or if you want to be really safe, really risk, like you're asking for your account to get blown, but um, you could also put your stop loss down there. I find myself doing that for the first like initial like couple minutes of the trade, but once you see just like displacement going into your direction or into your objective, like this candle right here, once this printed, automatic like you want to jam your stop loss up. to reduce risk as much as possible. Obviously, your fill would have been probably somewhere around here, so still you have a lot of risk on the table. But I mean, your uh, margin of profit would have been really high. I didn't take this trade. Like I said, I didn't say that in this video. I was busy this morning. I'm on range, so like my whole mornings are kind of eaten up. It's so annoying. I feel like I haven't had like I just had like constant weeks of like super early mornings, or like I mean I can still kind of trade while I'm like going to work in the morning, but like the stuff I've been doing is like you can't even use your phones. So that's been kind of annoying to work through, but it's all right. I'm still studying. I'm still trading a bit, but it's just hard to find the right time because I never want to trade like in a rush or like not fully seeing the full picture because it just it's a recipe for like stupid mistakes. Okay, so this would have been a good entry for longs. You could use probably this one too. That would have been one, but like this is a much smaller fair value gap than this. So this like creates, and this one was during the macro, so it has a lot more influence on price. Or you could have waited even until this one and then had a lot less risk and just putting your stop loss here, right? It's all about like entries and stop losses. I feel like is the hardest thing to do in trading because it just determines like how much risk you're going to have on the table, and then it's going to determine how much money you make on the actual trade. Like anyone can see like it swept sell side liquidity. It's below 0.830. You have an inversion fair value gap. You have multiple inversion fair value gaps that would have worked. So it's hard choosing the ones that work. Typically, you want to choose the ones that are created in macros, but sometimes they create big risk. So it's really hard to, like, you can't be too nitpicky with the price. You can, if you demand your perfect precision from price and yourself at all times, you're going to miss out on a lot of trades. And that's just not the way to do it. Like you have to trust what you've learned, and you just have to trust. And then on top of that, like in trusting yourself, you have to build that trust with yourself, which means taking trades that you shouldn't be taking stupid trades because each stupid trade you make, it's a setback. So, and it kind of just breaks the trust that you have with yourself and your confidence in the market. So it's just you gotta like once you have a model that works, like this one clearly works. I've seen it work. I've used it. The only times it's failed is one, if some big news was going on and I didn't know about it, which is usually not the case because I'll check the news. Or two, damn, I forgot what I was gonna say on two. Yeah, I was just gonna move past that, but on to what I wanted to show you guys. New pane. Okay, compare times here. Compare the times. 0955 creates this swing low. 10 11. So what is this? Why is this important to me? Because it's just another confirmer you could use, which takes a bit of an eye to recognize, but it's very wait, what the fuck? Trend angle, bitch. I want a fucking wait. I want a trend line. Okay, so if you just do this, you can see this is like slightly inclined, and this is slightly declined. But these markets, the ES and NASDAQ, are traditionally supposed to always be correlated. So what does it mean when they're not correlated? Well, it's called an SMT, Smart Money Tool divergence. There is divergence in price between the markets that are supposed to be in confluence with each other, um, meaning that they're supposed to match each other. And this is another indicator that on ES, sell side liquidity has been taken. So, and Nasdaq shows a failure to do so. So, what does that tell me? Well, on the market that the confluencing market, I don't know how the fuck to say it. The market that's supposed to be the same as Nasdaq did something different, which supports my like higher objective of price going to premiums. And this is SMT. I don't use it a lot. I probably should. I just think it's like I already have enough. Like, like I already have enough confirmers. You can't have so many fucking confirmers. It's just gonna slow your process. Like enough is enough. But if you're like that guy that needs like all the fucking answers to the test, like you can go ahead and fucking use the SMT. It's not always there though. Like it could match, and then it could have still done exactly what it does here, right? SMT divergence is not always there, and it should not be a requirement for you to get into a trade. It could be if you add it to your model, but it's going to make you miss out on a lot of trades because sometimes the markets are in sync and it's just going to do what it's supposed to do. Sometimes they're out of sync, and it can kind of tell you, it can kind of help tell you, like, oh, like, like ES already took sell side, NASDAQ failed to, and they're on the same time. So you can see like 10, 11, ES took sell stops. Nasdaq did not. What did it do next? Okay, and inverted the small fair value gap. Okay, now what did it do? Okay, now inverted this one. All right, now I'm convinced that price wants to go higher. You know, just a little tool, another tool that you could use. I mean, ICT got all the motherfucking tricks in the bag. You could fucking go on for days. Like I haven't even gotten to like I don't even use half of his shit, and it's already like enough. Way well enough. Yeah, this video is too long though. I'll see you guys later. Hope you enjoyed. Peace.